Is corporate debt really that big of a deal? All right, so I'm reading my book, Edward Chancellor, The Price of Time. One second. Is texted. All right, so anyway, I got texted. Whenever your wife texts, you text back right away. All right, so we got this right here. I read my man Ed Chancellor, who I like, actually, big fan. I love this book, and I like Ed Chancellor because he's not a big lib. You know, he's on the right side of things, the good guy side. You know, he talks about the Austrian School of Economics, the Mises. And I found this book through a Mises Institute interview he did in the Austrian magazine, which I get because I donate like $100 a year to the Mises Institute or something like that. So he's not a Keynesian. You know, those are the bad guys. We're the good guys. We're the righteous. They're not. All right. So how dare you? I don't care. So I'm in the chapter now. We're talking about stock buybacks. You know, the funneling it with corporate debt and how that's bad. And it's a very alluring argument. I'm sympathetic to the argument because I cannot stand how many hedge fund managers run the world now. It drives me insane. Like just how many NHL, NBA teams are run by hedge fund managers with tax dollars to build their stupid stadiums and all that stuff. It's insane, and I just and I don't like it. And I was looking. It's bad, dude. The money. I'm not talking the moneyed interest. I'm talking the moneyed interest. I'm talking the moneyed interest who do nothing but push paper from point A to point B. And I hate it, not gonna lie to you. And they need to pay more in taxes for that because they're not doing anything, generally speaking, to create wealth. They're just not, dude. Mitt Romney did not do anything at Bain Capital to create wealth. They extracted wealth. That's a fact. And so that's where I'm coming from. I don't have any qualm acknowledging that. But I'm reading this, and everyone is diatribing from Chuck Schumer to Sniffy Joe to even right wing guys about stock buybacks financed by corporate debt. And my spidey senses kick in. I said, there's always a second point of view. Always. Everything you do, and listen, there's always a second point of view. Evolution, we know there's a second point of view of that because we know evolution has never been proven. You can't prove it. Macroevolution, no one's ever seen it. It's just dumb. So if everyone is going this way, your first reaction, if you're true contrarian, is like, what's the other side saying on that? And you have to learn the other side because if you don't, you're going to be a sheep just like everybody else. Don't do that. All right, so my first thing I said, well, let's take a look at corporate debt. And here we are. And this looks bad. You can see from right here, we had a doubling of corporate debt from 2010 to basically 2022. It went from basically 6 million in 2010 to about 20 to 12 million now. So over the last 10 years, roughly, we've had a doubling of corporate debt. That looks bad. But does it? And let me show you what I'm talking about. All right, so if we go edit and we go by a log, all right, we'll talk about that here in just a second. That's that doubling of corporate debt. It looks pretty flat to me, doesn't it? Yes, it does. Now, it's a doubling of corporate debt over 10 years. That's a 7.2% increase each year in debt. But look at this. Look at that. So let's take the log off. Now, I talk about this in my new book, Relax and Retire. All right, and you should buy it right now on Amazon. So let's go on. We'll go to 1970. All right, so Q4 1970, we had $363 billion of debt. Q4 1980, we had $919 billion of debt. It's a 250% increase in debt from 1970 to 1980. From 1980, we had $919 billion of debt. And the end of 1990, we had 2.5, again, a 250% increase in debt. 1990, we had $2.5 billion of debt. 2000, we had 4.6. Not quite a doubling, but pretty close. So this right here looks bad if it's on a linear scale, but if you actually log it, check this out. It doesn't look nearly as bad. In fact, you can see the massive amounts of debt we're basically from look at that. From all the way, that right there is a huge rise of debt. This has been a leveling off. And again, the log is just percentages as opposed to raw dollars. So remember, I got to try to explain this. If you have a $10 and your profits grow by 10%, that's $1. All right. If you have $100 and your profits grow by 10%, that's $10. On a linear scale, that looks like the 10 is significantly higher than the 1 because the linear scale just shows the actual dollars. All right. The log scale shows the percentages, and the percentage in this case is the exact same thing. It doesn't matter. And so the log scale is all that matters over a long time. All right. So I'm looking at that, and then I'm reading, okay, well, that's good. And then I'm reading this right here from this guy in Seeking Alpha. Talk about Disney again. All right, so we're going to show you something here. When cash flows worsen, the debt becomes less sustainable, which is why the last 12 months, funds from operations can no longer cover interest and total debt as in the past. After all, huge cash flows have to be generated to support $48 billion in debt. And then he talks about a large amount of debt will mature the next 5 years, which includes interest far exceeding their free cash flow. The issue is here is not whether debt will be repaid, but at what interest rate will the new debt be refinanced? That's an interesting thing. That is a concern. The interest Disney pays is already, in fact, high. It covers 23% of operating income. And that's why the government has every incentive to keep the interest rates down, because the federal government is even more in debt. Now, this guy, is funny. Whatever, I'm not going to get to that. So I'm sitting there thinking, okay, so we just showed you that corporate debt in of itself isn't significantly higher than it's ever been in terms of the percentages. There are some instances where corporate debt could be a big problem. Disney comes to mind. But check this out. So this is net corporate dividends paid on the left, and that's going to be in the red. So you can see the dividends paid tracks the debt taken as well. I hope that makes sense. So again, from a log perspective of percentages, this is the corporate dividends, the red, and here's the debt taken on. All right, so they're tracking pretty significantly, if that makes sense. So a lot of the debt being used to pay the corporate dividends? Maybe, and that's again, we talk about it a million times a Sunday. We're incentivized to take on debt as a corporation because you get to write off the debt. All right, so debt gets written off as an interest expense on your EBITDA, earnings before interest, not EBITDA. Your net cash flow is what it is. So debt gets written off as an expense, interest expense from EBITDA. That's what it is. Anyway, dividends are double taxed. The tax a corporation who taxes through profits that they pay out in dividends, and then it taxes to you as you receive the dividends. So there's every incentive in the tax code to take on debt without question, even if you got to use that debt to pay dividends. That's a concern of mine, not going to lie to you. But again, the debt in of itself hasn't been significant relative to the last 50, 100 years, essentially, in corporate America. It just hasn't. Again, individual companies are different. So I want to show you something else too. So just as an FYI, we're using non-financial corporate debt here. We're not using bank debt. And I'll show you why here. Because if we use bank debt, I'm going to show you, if I can find it. Hold on a second. Right there. So this guy over at New York University, look, and these finance professors are, whatever, they're dime a dozen. But this guy's, I just like spreadsheets. I'm a spreadsheet guy. Friggin' send me to jail. I thought it was pretty interesting. So here's, if I can go over, yeah. So here we got, look, banks, and brokerage accounts, debt. See the amount of debt that these guys have. So you got to separate financial debt from non-financial companies, which is what that chart from the Fed did. The St. Louis Federal Reserve Board. They say corporate debt, non-financial, because here's banks, and brokerage accounts. Look how much more debt right there. Look how much more debt these guys have than everybody else. Because financial operations, it requires a lot of debt, a lot of leverage. There's no other way around that. I mean, it's just literally when you are making a deposit at the bank, they are accumulating debt. They owe you something. It's a liability on the bank's profit and loss, the balance sheet. If I have a $100,000 CD at the bank now has $100,000 of a liability for which they owe to me with interest. Now, what they do is it's essentially rolling the dice or running cards or running numbers, I guess. Is they're taking my money and they're giving me 3% and they're turning out loaning it to you at 5%. That's it's no different than numbers. That's not a Ponzi scheme, but it's like a mob guy does. We're running numbers, man, but they do it legally. All right, be that as it may. It is what it is, man. I did think it was pretty interesting. I wanted to show you some what was kind of so these are all the debt that conventional debt these industries have. We got auto parts has 20. I don't know if that's billion. I assume that's billion. Yeah, I'm sure it is. But look, we have chemical diversified, only $5 billion of debt. Now that's interesting. Coal and related energy, only $3 billion of debt. I find that very interesting. Electronics are it's going to be tough to make a lot of money in electronics because of cheap stuff from the foreign countries. But right here, office equipment, only $6 billion of debt. Paper, where's paper in here someplace? Where's paper? Look at that, $3 billion of debt. You got to be careful buying the debt, just like we talked about with Disney, because debt you got high debt, and those loans roll up again at a higher interest rate. It's going to hurt bottom line. All right, so that's my own spreadsheet. I'm doing on a long-term the Vanguard value index fund going back to its inception for dividends. We'll get in that later. So what people say is that the debt is being used to finance share buybacks and dividend payouts, and not for R&D, research and development. Basically, they're not reinvesting in the company. And I'm like, is that true? Is that true? I don't know that to be true. Now, Disney, well, let me go back to Disney. Look at this. I mean, yes, I agree. Look at this, dude. Here's Disney. I mean, look, they got ESPN, content sales licensing, ESPN. I mean, so basically, Disney now, 63% of their revenue is from media and entertainment, sports. What the hell? Yeah, and only 37% of their net profits comes from media and entertainment. The basic firm of Disney is still the most profitable entity that is. It's the Pareto rule. 80% of profits from 20% of the people, essentially. So Disney is literally spending 63% of its revenue comes from media and entertainment, which only accounts for a third of its net profits. Isn't that crazy? It's just, this is what happens with these big corporate conglomerates. They just start getting itchy fingers. I want to buy, like GE did. I mean, this is what happens, and all these things are doomed to fail. It's a diversification, not diversification, diversification. But anyway, so let's go back to R&D. So I had R&D right here. Gross domestic product, research and development. Let's just look at this from the Fed. And you can see R&D. It's not like research and development is, we can edit this from a Logit as well. But it's not like it's fallen off. Here we go. Again, the big growth was right in here from the 60s to the 80s, but it's not like, it has a decent little chunk. Again, it's not like it hasn't grown. It's not like R&D is going down. It's not. You can see it. No, it's not. We'll even not log that. There is growth in R&D, man. Again, from 1980, right here, we had 66, I guess that's billion, whatever it is, 66 billion to 1990. We had 168 billion. That's about 250% or so. From 2000, and we'll go to 10, 421 billion to 927. Again, about over 100% increase in more than that in R&D. So you can't say that R&D is not. It might be lessened relative to what it should be, quote unquote, if they didn't do their share buybacks. But you can't sit there and say R&D is being not looked at when in fact it's just not there. In fact, we're going to look at this article right here from Harvard Business Review, which I thought was pretty interesting. Right here. The numbers appear to provide evidence that the S&P 500 firms are draining themselves of capital for the long term if firms are distributing almost all their net income through dividends and buyback. The argument goes, how could they not be underinvesting? But a closer examination of the data conclude that call that into question. If companies are distributing nearly all their net income to shareholders, one would expect to see little corporate investment. However, when we look at CapEx and R&D as a percentage of revenue over the past 25 years, we see the overall investment intensity of the S&P 500 firms, while quite volatile year to year, has been rising over the past decade and is now near peak levels not seen since the late 1990s. Clearly, S&P 500 firms have found substantial capital for investment, notwithstanding large shareholder payouts and, again, dividends and stock buybacks. Cash balances are robust. Even though the investment intensity of the S&P 500 has been steadily rising, one could argue it might be even higher if firms did not distribute so much of their capital to shareholders through buybacks and dividends and funding for dividends, essentially. But corporate cash stockpiles are huge, and this is written in 2018. But still, they're huge, corporate cash. Over the next decade, they accumulate significantly more, ending up with $4.3 trillion in 2016, which is 50% above where it was in 2007. In addition, net income, against which shareholder payouts are often compared, is a poor measure of the income available for internal investment. This makes sense right here. Why? Because they assume the expenses deducted to arrive at net income are entirely unrelated to future-oriented investment. But one of the major expense items deducted is R&D. R&D is earnings before interest, taxes, debt, amortization. All right, well, R&D is part of the cost of goods sold. It is a deductible expense. So if you're going to take net income and say we're not investing enough for R&D. Well, R&D comes off before net income. It's like a top of the line deduction if you think about your 1040. I mean, you can't say net income. We're not doing enough in R&D net income when net income is derived by taking deduction of R&D. I hope that it probably doesn't. That's fine. But one of the major expense items deducted is R&D, which by its very nature is future oriented. At most, therefore, net income indicates the amount available for CapEx and additional R&D. 100%. We calculate the total R&D expenditures amounted to about 28% of total net income for S&P 500 firms from 2007 to 2016. When we add R&D expenses, net of tax effects, back into net income to arrive at R&D adjusted net income, we then take the account of equity issuance as well, and things look very different. From 2007 to 2016, net shareholder payouts constitute only 41% of R&D adjusted net income. That left the S&P 500 with a $5.2 trillion for CapEx, R&D, and other investments. Now you can make a case that they're taking that $5.2 trillion and they're making these freaking insane purchases of ESPN and stuff. I got no problem with that. I mean, lots of studies in business journals will say diversification. You're buying companies that have nothing to do with your core competency. But I mean, in of itself, cash buybacks, they don't do that. Cash buybacks just say we're going to reduce the number of shares outstanding, which means for you as an investor, that's good. And for you as a dividend holder, if they're using it, floating short-term or low-expense debt to finance your dividends, because they have cash flow, funds from operations, that's fine too. Because the tax expense, again, on debt is deductible. The tax expense is not from a dividend. So you're like, all right, instead of using cash flow, we'll just use it from expense when we get from a bond sale. Again, you got to be careful here. We don't want to be like Disney and head over the heels in debt with stupid conglomerates. But what I'm saying is just because people say cash buybacks are bad, there's always a side story to this, dude. Always. Anyway, and I don't know. I don't know. I mean, I just, debt is bad. No other way around that. But if debt is being financed by a cash flow operations, fund from operations, if you will, net income, if you will, I mean, who cares? Obviously, if the debt keeps accumulating and accumulating and accumulating and the funds from operation, your free cash flow drops, that's bad. We don't want that. Is that happening? I don't think so. Look, I come in here trying to be negative on this stuff, on corporate America, but I can't be, because I'm sitting there thinking, there's a second side of these stories, dude, that no one talks about. No, don't forget my new book's available out there. Love to hear your thoughts. Don't forget to subscribe to Doobie Doo, and we'll see you guys later.